My name is Chris Dreyer. I'm the CEO of CFA Switzerland. CFA Switzerland is the alumni organization of CFA charterholders in Switzerland. Been in that role for a bit more than 3 years now. Previously been with a large bank, my own consultancy for pension firms. Always been in the institutional investment industry, if you like. I've done political economics in St. Gallen and a Master of Laws at Edinburgh University and obviously the CFA Charter. I'm a generalist by education, but I've been in finance for quite long while now. Well, basically all my career in different roles, from CFO to business development to head of investment research, quite a gamut of different functions and roles. CFA is the gold standard. That's a quote from The Economist. The gold standard in finance education. It's a self-study program. It's called the Chartered Financial Analyst, but it's not just for financial analysts, the traditional understanding or role of financial analysts. It's really quite a generalist finance program which covers a lot of different areas. We've got a very strong code of ethics and standards of professional conduct, the Bible of every CFA student, and that's also a strong guidance which is binding for all our members, of which there are I think 140,000 on last count globally. In Switzerland we have 2,800, 900 approaching soon. And as I say, they're all bound by this code of ethics, standards of professional conduct, and that's obviously something that is a big challenge for all the industry in the wake of the financial crisis, etc. I understand my role, or the role of CFA Switzerland, very much as being working with the finance industry quite closely. In a number of ways, in developing the education of finance professionals, specifically of our members, continuing education, as well as hopefully promoting professionalism, ethical behavior in the industry, and also having a bit of a longer term perspective and time horizon in behavior of the industry. Well, innovation in the financial sector is a bit of an elusive topic, right? I'm sure you know Volcker's statement that the only useful innovation in finance was the ATM. There is one aspect in innovation in finance which is about rising complexity of financial products, etc. But typically, rising complexity in financial products typically only serves the issuer, hardly ever the client. So that's probably not really that useful an innovation. But I think when technology and finance come together, as they have started to come recently, there is a different dimension of usefulness that may come to play. But it's very much something that is that needs to respect the regulatory dimension, because hugely different to what the typical technology sector does. Finance is very deeply and strongly regulated, whereas technology is hardly so. And many tech entrepreneurs looking at the finance industry think that regulation in finance is something that might just go away if they're just bringing some strong enough innovative business model to play. But I'm pretty certain that this is a wrong presumption. Obviously, banks have been using technology for a long time, but just as sort of reinforced calculators, bigger calculators if you want. But when it really comes to deploying technology in novel ways, that's something that they've been sorely lacking until quite recently. And that's not least due to the fact also of regulation, which is not really technology neutral, or the term that I prefer is actually technology agnostic. Because the way in which the Swiss regulator, for instance, interprets technology neutrality is just gets a little bit one step removed from paper technology, which is a technology in itself, but not as far removed from the technology as to really make it technology agnostic. So, for instance, there's been this recent video guideline which serves banks which want to open up new contractual relationships, new business with clients they have met so far over video channels. And FINMA has done a 20-page guideline about how to do that, specifically describing the steps and tools, etc., introducing a way of uniformity for banks to do that. Whereas in comparison, Singapore's MAS is achieving the same goal with 3 paragraphs, essentially, stating a very strict equivalence principle. So basically what they're saying is that when you use technology to open banking relationships with new clients, then you must assure that you achieve at least the same KYC, know your client, as with the traditional business. And the rest is your responsibility. Obviously, that latter part, the rest is your responsibility, is something that the industry here, and by here I mean in Europe, doesn't like, because they prefer to have uniformity and certainty, prescription given to them by the regulator as well. And that's something that introduces, as I say, uniformity, and takes away the possibility of playing with technology and really trying out multiple avenues. And what has shown the history of technology so far has shown us amply that experimentation is really crucial. But and that brings me to a second important topic. Banks, in my mind, are constitutionally unable to experiment. They must not, they cannot experiment. I mean, if you talk about failure rates of 80% of startups, a project manager in a bank who has 8% will be considered a failure, let alone 80. If they are subject to the traditional prescription of the banking business, then they have to take a banking license, and that's a different picture. That's also another yet another topic of discussion. Is the banking license the end all and be all of financial services? Which is what it is in Switzerland currently. Everything leads into the banking license ultimately. If you're big enough in financial services, you'll have to have a banking license. I'm always looking for interesting regulatory models and models that we can learn from and compare with. That benchmarking. Regulatory benchmark is something that the regulator hardly ever does, obviously, because they wouldn't care too much, but the entrepreneurs they regularly do it, because they evaluate the market size and the other the barrier to enter that market, which is obviously kept by the regulator. So that comparison is something that's really happening often or all the time in the entrepreneurial space. If you want to, and that's what I consider our mission as well, to help the financial center Switzerland, the Finanzplatz, to really stay or become even more competitive, then that's what we're very interested in. the traditional startup world of finance and technology models that are beginning or looking to disrupt the financial services industry. That's something that is really quite novel. That has started in the last 2-3 years, maybe. That's definitely true. Yeah. And if you want to focus on that as fintech, and that's by the way also the one of the segments that the Swiss Finance and Technology Association, of which I'm a board member, is also looking at to foster and help that ecosystem of the different players in the Swiss finance fintech world. Then that's certainly something that has become quite vibrant over the last couple of years, and I think there's a lot that speaks for that to happen in Switzerland. Obviously, we have very strong engineering schools who bring in those engineering skills. We can bring that together with a strong finance community in the country, even though there are some detracting factors there in that strong finance community obviously pays humongous salaries, which fintech startups will have trouble matching. So you'll have to have a really healthy appetite for risk to actually make that move or make the change from a traditional finance role into a fintech role, just from a compensation standpoint. But then again, maybe the pressure that the finance industry is increasingly coming under that helps as well. But yeah, there's a range of different models that are coming on screen or on the radar of fintech. So, for instance, the robo advisors, some insurance tech, a bit of reg tech. Strangely, crowdfunding is hardly playing a role at all in Switzerland. Oh, by the way, the CFA Institute has done a survey a couple of weeks back, or published a survey, a worldwide survey about fintech, and we have been able to carve out the Swiss responses, or the responses from Switzerland and the UK, compare them to the rest of the world and the UK responses as well. And there we've had a couple of quite interesting responses. One of them was that the Swiss respondents felt particularly comfortable with fintech in general and robo-advisors in particular. They felt that they had looked quite a lot into the matter and knew their way around it. Quite in stark contrast to UK respondents, who only apparently seem to have dabbled into it. And also Swiss respondents felt that the whole range of clients would be impacted by these models, by these different approaches to essentially relationship management. Whereas the world and UK respondents as well felt that the high net worth, ultra high net worth world would not be that impacted. That would be business as usual in those domains. And another interesting aspect which brought me to think of it, is the lack of a role that crowdfunding plays in the Swiss perception, which is basically essentially zero. Again, in stark contrast to the rest of the world. I'm guessing actually that this is again the huge impact of the Swiss practice on banking. So basically, as soon as you get money in from 20 plus people, then you need to have a banking license. Which obviously is a risk that not very many crowdfunders are prepared to take. The regulator has certainly made huge steps forward in terms of acknowledging the phenomenon to start with, and also getting ready to address the most burning issues for many fintech startups. FINMA so far, the key clients of FINMA obviously were banks with typically huge legal departments, and their counterparties were well versed in banking regulation, etc. So it's basically peers talking among each other, right? The conversation was a really established one. Whereas enter the fintech player with some engineers, maybe a finance professional in there, no legal department to speak of, so probably no regulatory know-how either. They expect the regulator to be sort of a service provider in a sense, responding rapidly and trying to basically help them find solutions. Obviously, that doesn't end well. That sort of expectation, or that doesn't really work in when it comes to the practice of the regulator. So there's some changes required on either side. One is that the regulator needs to get a better understanding of what's taking place there, but probably even more importantly, also the fintech space, the entrepreneurial space, need to develop an understanding for one, the legitimacy of financial regulation and the goals of financial regulation, and also that there is that they need to comply with it eventually. They need to bring to play ideas and proposals on how regulatory goals can be achieved through their new ways of practicing things. But it's certainly not a free-for-all in that regard. The business point of departure, if you like, really is that Switzerland so far has been the traditional model of wealth management. So practically a large part of Switzerland's financial services is really about wealth management, either offshore, which is under pressure, or onshore, which is relatively small. But that's what it is. And if you compare that to the UK, for instance, UK is second, actually third even, in terms of the global ranking in offshore wealth management. So that plays a relatively smaller role, but the financial services economy in the UK is much more diverse compared to the Swiss financial economy, and also the value chain hence is much more diverse. You will find many more specialized service providers who are thinking oftentimes about how they can develop, automate, structure their ways of doing business by using technology. Whereas the incentives in the traditional Swiss wealth management model so far haven't been very strong to develop that thinking. But I don't think that this means this will continue to be so. The fact is that wealth management, to a large extent, is about relationship management. And if you come across a population that is changing, of clients, obviously that is changing, and they are by necessity changing. They're changing generations, they're changing their practices. We're not talking about untaxed money anymore. We're talking about openly taxed money, which means that you have to have a real value add, not just the savings in tax. You need to actually deliver risk corrected performance, transparency about what you do. Price competition is beginning to play a role as the service component. All these things will lead to a much more evaluative behavior of the of the younger generation of the client base, and they are familiar with digital ways of doing business. Everybody does e-banking nowadays, but this will go much beyond what a traditional e-banking service is. We have these huge behemoths in Switzerland, UBS, Credit Suisse, etc., which are assembly lines, if you want, of wealth management services. They are at risk to be broken into individual pieces where each of those pieces may deliver their service in a much more specialized, much more effective way, potentially cheaper as well. And technology would enable that to work together, to interact quite well. So that's the way in which I believe the longer term perspective will be that the Swiss financial services industry will be delivering with fintech. How is it going to play out? That's a good question. I'm thinking about. Well, but basically, I'm always looking for models and other historical precedents in a way, and how other industries handle innovation and change. And a good example, I believe, an example which allows a number of conclusions is the pharmaceutical big pharma industry, which obviously has innovation built into their DNA. The R&D of big pharma is big. They invest a lot of capital into that, and there's a huge risk involved in it, and it takes years for medical innovation to come to fruition. They tend to move their R&D out of the corporate context into spin-offs, into university-assisted startups with some licensing deals of different structures. And as soon as they came through the stage 3 or whatever, the risk went down. Prices went up. They reintegrated or entered into exclusive licensing arrangements, thereby becoming big pharma becoming the huge distribution channel that it always is, and exclusively being a distribution channel essentially to the world. And I think a lot of the current thinking of the financial services industry is along those lines. Let's just look at the fintech space, but observe what these tiny startups do, and then once they become successful, once we see a model developing that might fit into our corporate world very well, let's just buy them. We sit on the money, and those guys will be relatively cheap. And then we can basically scale them up to the needs of our client base. So that's the way I think the traditional innovation approach of corporate. Of the corporate finance, well, that's also not the right term, but you know what I mean. What the big financial services providers are thinking along the ways of. What I think they're missing, though, is that those small fintech startups have, in a way, ways to quickly attract a huge client base themselves. So the financial services is not in the same way the traditional distribution channel, or does not exclusively own the client relationship as big pharma did, but the fintech startup world may quickly attract their own important client base, or they may come or be bought up by a huge tech entrepreneur. Let's talk about the Googles and Apples of the world, who have millions and millions of paying client accounts as well, which then can come into rapid competition as well with the established players in that field. there's that tension, I believe, between how you deal with innovation and you think you have it under control in a pharma world, whereas in the financial services world, I'm pretty sure it's going to be much muddier and much less clear cut. They're trying hard, but I don't see that they can. Because obviously the barriers to entry are much lower, especially if you don't operate a traditional banking model. If you do traditional banking, then obviously you will come under the need to actually have a banking license immediately with all the capital requirements, etc. But if you do anything else but that, if you're a robo-advisor, etc., you really don't need that to have a banking license. You may want to work with a bank to provide you custodial services, etc. But then traditional banks become just an established a platform, an execution platform, which is a discount operating model, and a very competitive and commoditizable business model, and the value add on top of it, and especially also the client relationship is really owned by your other service, by the FinTech enterprise. If they want to really grow their own business, if they have that ambition, they're learning rapidly that they can't just wait for. I think the technical term is spontaneous private deregulation, which I quite like as a term. That's I've learned about that in the context of the introduction of the automobile at the beginning of the 20th century, basically when you had still your horse carriages and the speed limits of 5 kilometers, and you had somebody having to walk in front of your car waving a flag, and that's all state prescribed, right? And then the wave of new cars came in, and the state quickly realized that the old ways of doing things doesn't work anymore. So they basically introduced that pressure to deregulate quite rapidly. So there is some ways of that you can expect something like that to happen. But still, when it comes to protecting the financial system against destabilizing effects, for instance, then that's certainly something that prudential regulators will be very careful to release the reins of that. And also when it comes to protecting the client against bank runs, etc., or bankruptcies, failures of banks, then that's certainly another game. But otherwise, I think there are business opportunities, models where the entrepreneurs can create value and could also attract clients quite fast. Question though is the market ready to jump ship? That's a whole different ballgame. From experience, I can tell you that the Swiss traditional client is not very experimentally orientated. We're not traditional early movers or fast adopters even. Especially when it comes to really crucial, important services like banking. So I'm not so. I don't think that new innovative models will quickly find an important following in Switzerland, especially. So they would have to be able to also attract an international clientele, and whether that works in terms of cross-border business, that's another obviously a very important question. when you offer a business that is regulated in the market that your client is resident of, then you will also probably have to comply with those regulation in market. And whether a small startup can handle those requirements, that's a big one. Probably if they focus really on individual markets, identifying first which are the suitable markets with a proper market assessment, and then focusing on one by one, I guess so. If they can raise the capital, there's another issue. If they can raise enough capital again in market to finance these outlays, which are important. There are certainly players who do the due diligence and who do look, who prioritize markets, look at what is required to enter, say, Germany as a market, and raise capital in order to achieve that. Others are going through the moves, but basically, essentially thinking about an industry exit. So you see that that's the sort of thing that they can think, well, we get bought out, and then let's leave that to our parent who have the big enough wallet to fund that once it gets to that, right? The thing is, the bold and brash approach to doing things has a degree of not really being realistic, I sense, especially not in the financial services world, with that strong permeation of regulation and how business is done in that domain. And they will not be able to convince the regulator to change over, to flip the switch, basically, to do that their way, essentially. So I think there's a degree of overconfidence in that. Which is probably matched by a huge degree of underconfidence, typically on the continent, or especially in Switzerland, of entrepreneurs in that space, who very often really don't think big enough, even though if they had a proper strategy of building with, of working with industry partners, developing the regulatory landscape, etc., that they would have some ways to actually effectuate change. There's a number of factors that are very important constraints for Swiss FinTech, and that is if you accept the fact that if you're based in Switzerland, you're addressing the Swiss market as such with, I don't know, 3-4 million potential clients who are split in 3 language regions. And that's just talking retail clients. If you have more specialized needs, then the market gets even smaller. And obviously, it's not by any means an uncontested market. So speak tiny market. No passport into the EU, so no direct market access. There is that question of do you have enough of a critical size of the marketplace, even if your business model holds, do you have enough of that critical market size to get your business really going, to establish the proof of concept within a working client base, and to scale that up to larger markets? Then that'll be a difficult sell for the Swiss fintech space. So in that regard, there is certainly an important constraint that will make life that does make life difficult for them. But that is met I think by very favorable conditions in terms of an innovative spirit in all the engineering space that we have. There are pockets of investors as well in this domain, increasingly so as well. So I think there is an emerging landscape of investors who are looking into that space to develop that further. So the jury, in essence, is obviously still out. But it's certainly not the easiest proposition to start an internationally recognized fintech from Switzerland, just by itself, and not without having one of the big banks backing you. Some banks are also working hard in the specific technical domains, trying to integrate that into their operations. But then what I said before about the risk culture in banks, in the business models of banks comes to play, right? So they can't really be very bold in the way they experiment. What I'm just, and I'm sure they are equally nervous about, is that they might quickly be overtaken by what is happening outside of the traditional banking space. So, say if an Alipay, if these players enter the frame, look at Apple Pay entering the Swiss market in a couple of weeks' time. I'm sure all the payments people are nervous as hell about what is going to happen, how the Swiss market is going to take that up. I'm going to be the first user of Apple Pay in Switzerland for sure. What are the location factors that are really critical and crucial to assist adoption of innovation in financial services in Switzerland? One of them certainly is there should be more risk capital entering that space, and that's not internal risk capital being allocated to functions within groups, but real seed risk capital that supports the entrepreneurial space. You can relatively easily start, but when it comes to second and third rounds, to really fund the large market expansion, etc. When we talk about real money, then there's a dearth of that. So that's certainly something that should be enhanced, and it's not like there is a lack of capital in this place. So that's not the issue. It's really about the lack of risk appetite to take that. And that's something that I believe can be changed. It's a question of the institutions, etc., to adopt that. And the other thing is, I'm afraid I'll have to come back to regulation. It is the way in which the regulator, and I mean now not FINMA, because FINMA is in a way not the regulator, but they're really the supervisory arm following regulatory guidelines given by the government and parliament, i.e. the law. So it's up to parliament, the government, to think innovatively and change maybe the ways in which FINMA, the supervisory authority, which plays an important role, is resourced and is mandated to create the framework conditions in Switzerland. And when I say that, I mean that they should actually get an explicit mandate, I believe, to look at the competitiveness of Switzerland as a financial center in the world to operate, which they currently don't have. And that is an impediment or a limitation of the way they can operate in that sense. So there's a couple of factors. I think those are the two most important ones. FinTech Made in Switzerland. I believe that Switzerland does or is a natural place for financial services in the broadest sense of the word that can be offered to the world, if you like. If those framework conditions were there, if we can marry the engineering panache and skill of the ETHs and EPFL, etc., with the finance skills of our finance community, and do that in an innovative way that really uses all the means of communication, etc., to develop tools that really can change the trade, then I think that a Swiss industry in that sense would be able to develop a global reach if they're supported again by a framework, by a regulatory framework that has that in mind. The Swiss financial service industry have been very adept scholars of the Anglo-Saxon way of doing finance and doing business, with many good, but also quite a number of bad implications. If we managed really to bring back the old ways, the old traditional Holzach type modest Swiss banker way of doing financial services business, marry that with innovative technology and really first-rate customer service, then I think that bringing back the work ethics and not just endless hours in the office, really, but the client centricity, then I think the Swiss fintech way of doing things would have a fabulous future in that sense. But yeah, that's the jury is very much out on that one. The societal benefits would be that obviously currently we do have a very strong financial services industry, which in a way has a lot of employs a lot of people. If that industry comes under pressure, then from an opportunity space, then obviously Switzerland would suffer if that industry couldn't develop any further or would be repressed in a way. If the traditional service propositions of Switzerland, i.e. the service orientation, the language capabilities, all these really traditional factors that the Swiss Finnish, and I don't mean that in the financial services world, the Swiss Finnish is well known for, then I think we can play that so that Swiss made also receives again a positive connotation in financial services, not just with watches and chocolates and cheese.